parameters they will look at. But Chetan, I mean, let's belabor this inflation point a bit more. All the more because the Reserve Bank governor, after looking at the September inflation numbers after they were announced, said that he will look at the disaggregated number. It's a statement we have rarely ever seen from the central bank governor. Now, if you look at the disaggregated number, he probably is referring to the fact that food inflation is what is up 16%. Non-food inflation is high. Yes, it's higher than what it was in August, but clearly it has been rising at a falling pace. Given that, do you think that the inflation problem, the worst is behind us, and the food inflation problem is anyway something the Reserve Bank cannot handle with interest rates? So would it make sense to pause now and not leave the option, but probably exercise it in December? Anyway, they have intra-quarter moves, meetings hereafter.
No, not Lata. I think if you look at the non-food inflation at the 7.4%, it's also stubbornly high. It's not going down. We are expecting inflation to go down to about 5.5 by March 2011, but then we are assuming that they will be at it and trying to continuously hike interest rates. If they don't, then you don't get that number. So you will take that risk of inflation actually staying stubbornly high and not come down to that comfort zone if they do not hike. And let's not just look at inflation, because all what we're trying to say is that the aggregate demand in the system is higher than supply. So inflation is one parameter, and how inflation number is calculated, we all don't know. It's a fuzzy number, but the current account deficit is a more accurate and very clear number that comes out, that we are importing more than what our exports are, and we've now seen 3 quarters in a row current account deficit at 4% of GDP. And at the same time, the third parameter to look at would be that the deposit growth remains very low at 14.3% year on year, while credit growth is at 19. The low deposit growth is also reflective of the fact that inflation expectations are high in the system, considering the level of interest rates that we have. So composite view gives us an indication that the RBI should stay on course and continue to lift policy rates.
Would you really worry about the IIP number, Chetan? I mean, it's been a very nasty shock at 5.67%. The other data that we are getting in terms of, say, PMI, which of course is a secondary data, but even that has been showing kind of getting stuck at that 55 number for the past 2 months. So would you say that there is allied information or allied data which is also indicating that probably growth is not at the frenetic pace it was, that it is probably stabilizing and even slowing? And if we stare at very slow global growth, which now appears to be a given, then maybe the growth argument is also important enough for the RBI to pause?
Whichever way you look at it, Lata, the number is definitely on a GDP basis above 8%. Whether you look at
8 is yes.
Yeah, so it's above 8%, which is fairly strong growth rates. And RBI's own annual report highlights that the potential growth rate had slowed down post-crisis because we did not invest for a while. My view is that the number was probably 7.5% and not 8 in terms of potential growth, because we really look at more the private sector investment, which fell by almost 4 percentage points. So with the potential growth that we had immediately post-crisis for a 12 to 18-month period, having 8% growth rate is actually already indicating that we are running slightly above our potential growth rate. So in my view, you have to stay on course and try to avoid any kind of potential macro stability risk, whether you call it current account deficit or whether you call it inflation.
So what would your growth and your RBI forecast be for the full year? How many more rate hikes are you expecting, and how much might that damage growth?
With the strong growth expectations of 8.5% that we have in our forecast, we expect RBI to continue to hike interest rates to about 6.5 to 7 by March 2011. We are at right now 6%, so that's what, 75 to 100 bips more by March.
Well, Hitendra, 75 basis is like pretty stiff. 75 to 100 basis points is with what Chetan is coming with. What's your own sense? Do you think, as it is, we're not seeing credit offtake pick up much. Do you think that at 75 this can be quite a deterrent, and what do you expect will be the impact on the 10-year? What do you expect, what is your sense will be the impact on corporate borrowing habits or borrowing trends if this is what RBI really goes with?
No, I think before I answer that question, I think I would say that apart from the inflation growth dynamic and the currency dynamic that we spoke about earlier, I think clearly RBI is very cognizant of the fact that what they have done over the last 4 months or 5 months is quite unprecedented. We have taken policy rates from an incredibly low 3/4 to currently above 6% in a very, very rapid time frame. We are used to getting policy rates slashed at this rate in the midst of a crisis, but in the midst of a normal cycle, we haven't really experienced such a sharp pickup or spike in the policy rates.
Hitendra, they were in a zone of irrelevance. Hitendra, at 3/4 the RBI had gone to irrelevance. So I don't know if that speed... Yeah, please go ahead.
No, I take that point that I think, as I'm saying, 3/4 was incredibly low. I'm just talking about the pace of the correction is quite unmatched in our history, let alone any other central bank that we have to compare with. And to your question about what does happen if there is a 75 or 100 basis point further hike in policy rates, my guess is, I think at this juncture the market really is providing for about a 50 basis points higher over the rest of this financial year, at the long bond yield levels. I mean, as in beyond 10 years or 10 years and beyond, and that therefore you are seeing 10-year bond at about 8%, reasonably well supported. But however, should you continue to have liquidity conditions like the way we have seen for 4-5 months, and with an RBI which is continuing to be on a hike beyond the 50 basis points expectation, we could see then the neutral 10-year bond, if you will call it, at about 8.5 rather than the current level of about 8.
Okay. Well, actually, there are just one final question on this issue. Do you think, therefore, the stage is set for some fairly active RBI intervention? Because if liquidity is, as you say, already short by 90,000 crores, and the biggest of RBI intervention has not begun, isn't it very easy for the RBI to intervene at this point in time, at least when you're going to have these lumpy flows coming in?
Well, the governor himself has said whenever there is a lumpy flow, to avoid the volatility, the Reserve Bank of India will intervene. There has been speculation in the market that over the course of this week there might have been some intervention. We will only know once we see the data after a week or so. But clearly, my guess is, post the large IPO which is opening on Monday, if we continue to see follow-through flows in the secondary market or in subsequent IPOs, and the rupee clearly moves away, it's already been questioned in terms of its fundamental move. But if it continues to accelerate, and the capital flows can really outlast your fundamental valuations all the time, I think there will come a time at which they have to draw a line in the sand, and that could be at anywhere below 44. I think we are in play for significant RBI action.
Okay, thanks Chetan, Hitendra, for your thoughts. Looks like both our experts believe that the Reserve Bank, by actually hiking rates on November 2nd, will be doing a service to growth and will not be really hurting growth. On that note, let's take a break. Another issue that came to a head this week was public and governmental angst over high interest rates charged by microfinance institutions. Coming up, a 360-degree perspective on the issues involved in the MFI sector.